Hi, everybody. Today I'm with Guillaume Fournier, who is also an investor and also doing videos on YouTube. Hi, Guillaume.
Hi, Christophe. Thank you
Oh,
for the invitation.
yeah, you're welcome. I think this will be very interesting for this audience because this is an audience of stock pickers. So this will be a technical call. You will share your experience because you've been investing in stocks for a few years. And here is my first question for you. Can you explain a little bit what your investing style is to the audience?
Yes, that's a pretty cool question because with experience, my style kind of changed a bit. When I started invested like 5, 6 years ago, I was in a stage of my life where I was just traveling and I was like, okay, how can I generate more passive income the with the less time possible on stock market, like looking at stock market and so on.
Mhm.
And at this moment, I was like, okay, like the best way is dividend stocks. But I like stock market is my passion. I was into it since I'm 17, 18. So I knew like going on 10% dividend stocks, 12% dividend stock is like completely stupid strategy. Like usually don't work. Like maybe if you're like a super smart or if you have some super good insight about a company, maybe you can do great by going on 10% dividend stock. But generally, it's never a good idea. It's never working well, especially that okay, you will have 10% per year from dividend, but most of times the stock will also go down 10% per year. So at the end of the day, you're flat and a little minus because you have tax to pay on your dividend. So it's not really interesting. So I was focusing mainly on stocks with a dividend between 3.5 and 7% because it's kind of the range where I saw that you also have some um, undervalued stock here is at 4%, you can have a stocks that generally have 1.52% dividend, but that the price fall, and now it's 4%. So if the business is still good, you can have some very good value deals with this. So I started investing like this. My main focus at this moment was first one to beat inflation, like to protect my money from inflation. I was not even looking at doing some performance because if you just want to do some performance, I could just buy a S&P 500 ETF. But the thing is, I wanted to protect myself against inflation and have a higher dividend return than the normal market. So that's why I was going onto this. And also I had a deep um, problem, let's say, with ETFs. Like it's really a product that I don't like. For me, it's against capitalism. It's against all the value of the stock market and so on. So I really cannot invest into ETF because it's not because of the fees and so on, but for me, it's stock markets. It was freedom. It was like I invest in stock market to grow my revenue, to acquire more freedom. But with ETF, I'm fully dependent on BlackRock. I'm fully dependent on MSCI, S&P Global, because they decide what is in the index. Then BlackRock decide if they want to do something on the on the index and on the ETFs that they will give you. And you as a customer, you just have zero control. You don't decide anything. For example, in France, 2 years ago, we had something very important that happened with ETF with a company named Amundi. It's like, let's say, the BlackRock out of France. And they have the biggest ETF that was on French market was about S&P 500. And from day to day, you just woke up and you realize that they hire the fees 50%, plus they put an ESG score to this ETF S&P 500 without notice, without you accepting it, nothing. So you have no power on this, and suddenly you wake up with 500 company in your portfolio, like from this ETF, with only 300 that are ESG friendly, plus 50% more fees. So when you see this, for me, I cannot tolerate this with my portfolio. So that's why I was on a dividend strategy at first.
Wow. Didn't know this about the ETF. But yeah, we are European guys. So ESG is important for most of the countries here. And
Yeah.
I mean, did you own the ETF at the time?
No, for me personally, I didn't own because since the beginning I was against ETF. So
Okay.
like there is zero ETF on my stock portfolio. I even rather have like 1% or 2% underperformance compared to S&P 500 ETF than having a ETF, because I will feel more safe and I will feel more, more safe with my money and more in control.
Yeah. Oh, that's funny. So, but are you still against the raw, normal ETFs, like an index that follows the S&P 500? Because if you don't have any time to invest and you just want to bet on your country, if you are somebody from the US, you just buy an ETF, S&P 500, and is this against capitalism to have a S&P 500 index without much fees?
Okay, because for example, look at something very. I just saw someone talking about this, like 1 week ago, about BlackRock that is putting pressure on Microsoft to buy Bitcoins.
Okay.
BlackRock putting pressure on Microsoft to buy Bitcoin. How can they put pressure on such a big company? Because BlackRock own 8% of Microsoft. Okay, maybe it's not BlackRock directly who owned it. It's a client who have ETF from BlackRock. But the thing is, you don't have the client on the board. At the moment that is BlackRock that is buying the share, the client gives the power to BlackRock. So, okay, BlackRock can put on their website something to vote, something to tell you, yeah, you still have some control.
Nobody
but
will
at
do
the
it.
end of the day, it's not you which is putting pressure on Microsoft to buy this Bitcoin. So I don't know if it's good, bad idea. The question here is not if it's a good or bad idea to buy a Bitcoin in your company, to have this as an asset. So the question here is like, I don't accept to give the power to BlackRock or to Vanguard, because it's not normal for me that they can put pressure just because a client have bought ETF from them. So that's
Okay.
what I'm against.
So if a lot of people put their money into ETFs, BlackRock and all these companies will have the power, and they may disrupt capitalism, telling companies what they should do. This is the whole thesis. They have a lot of money, so they have influence,
Yeah.
have a bubble of passive indexing, and they can mess up all the work from the big companies, Magnificent Seven, etc. Okay, no, okay, that's the first time I hear this, so that's interesting. And I guess Microsoft doesn't have to listen to them. They have a lot of cash. They can survive without them.
Of course, but if the thing is, when you're the number one on the board, when you own most of the company, like the most shares of the company, at some point, like you're the one having the power to decide who will be the CEO, who will go there, especially when the other one that on the board are kind of your friend. Because, yeah, okay, BlackRock is only 8% of Microsoft, but BlackRock plus Vanguard is 15%. BlackRock, Vanguard plus State Street is 20-25%. Then so you can really go higher and give kind of a lot of control to this. But of course, this is like a super. It's something like which is maybe unlikely to happen. It's something that, but it's just a concern that I'm not good with, so I don't want to participate.
You don't like it.
Exactly.
You can invest in whatever you want after all. That's your money. So you can,
Yeah.
if you're not comfortable buying ETFs for this reason or that reason, because of BlackRock, because of anything else, you find your dividend stocks, and that's working really well. Is your main goal to beat the inflation and beat the S&P 500, or do you index against European indices? Like we are French, so our index is the CAC 40. Do you compare your performance to the CAC 40? Are most of your stocks French companies, or do you diversify in the US and you compare yourself with the Nasdaq S&P 500?
So at the beginning, I was just on dividend, as I told you, but since 2 years, my strategy a bit evolved after a huge frustration from me, because in 2022, I missed 2 opportunities that I saw that I was like, damn, this is almost too good to be true. But I didn't invest because of this stupid rule of 4% of dividends, which was Meta and Williams Sonoma.
Okay.
Those 2 stocks, I was like, damn, like this is such a great opportunity. End of result in 2 years, like what? Meta is X5, X6, if I bought during this time in 2022, and Williams Sonoma X3, X4. So I a bit evolved into a 2 portfolio now. So I have the dividend one, which is the goal against inflation.
Okay.
And another one, which is, I will call it a quality value. I don't really know what word put on this one, but it's just to get opportunities that I feel that I can beat the market in the next 5, 10 years with those company. So I don't index against Europe because personally I kind of try, not try, but I kind of invest a bit everywhere. Of course, the goal is to beat the S&P 500 because I think it's kind of the worldwide reference. But if we look at my portfolio, I think the things that I will try to beat will be more like an MSCI World, MSCI ACWE, ACWI. But to be honest, I think I have one since a month. I have one stock in Europe.
Yeah, and you
It's
have
not even
stocks
in
in
euro.
China also.
And I have stocks in China, yeah, but it's not even in euro. The stocks that I have, so.
No, you can compare yourself to the MSCI index, world index. That's fine.
Yeah.
That's fine.
So
Most
this
people,
is the benchmark, yeah.
yeah, most people compare themselves to the S&P 500 because most of their investments are in the US, so that's normal. And we would do the same thing if most of our investments were in France. We would compare ourselves to a French CAC 40, which is easy to beat because of the recent underperformance. But all the European indices are, I mean, if you compare them to American ones, that's crazy. If you look at the 20-year performance for European indices, that's basically flat. If you look at the 20-year performance for the US, up and to the right. More cyclicality, more volatility, more pain, but more euphoria, and that goes up more. It's over 20 years.
And I really deeply don't understand why French people, for example, most of my clients, when they talk to me, they're like, yeah, I'm thinking about investing in this European stock, this European stock. I'm like, man, like, why you so focused on investing in Europe? You can have 10 times better stock for the same price earnings in US with a bigger dividend track record, with a better also environment to grow, because capitalism in US and capitalism in Europe is way different. You have way more regulation in Europe. It's way more free in US, so you have a better way to grow. You have less tax for company as well. So yeah, like honestly, now today I think my portfolio is 80% US.
Yeah, you have a better environment for picking stocks. This is a better pond to fish in. I mean, you have some great companies in Europe. You have some stocks, even in the UK market that everybody hates right now. Even in the UK, you have some good companies that have outperformed the market. But as a percentage, it's much more rare, much more unlikely that you will find the next double, triple in Europe. So for the same game, but it's much harder in Europe. You have Hermes, ASML, you have Games Workshop, Howden Joinery. You have great businesses in Europe, but the risk that you take is not worth it, in my opinion. I share the view, especially now as regulators increase regulation in Europe compared to the US, lower taxes in the US, more innovation in the US. I mean, it's very easy to compare the innovation for both continents. They have rockets, and we don't have much rockets. We don't have robots for the moment. Especially, I mean, have you seen the iPhone? The iPhone release in Europe. For the new iPhone in the US, you had all the AI assistant tools for the iPhone, and for Europe, it was not possible to have them. So you get the same price, but for less stuff,
like
basically.
It's crazy. And I don't know how is it possible that in Europe they have such an like they don't see that they are just destroying the innovation. Like I was listening and some people making jokes. They were saying like, I don't know, there is this super famous meme where you have America innovate, Europe regulate, and China copy. And now we're more into like China innovate as well, but Europe is still regulating everything. And even worse, I saw like someone going into the French budget of the government, and apparently they are sending hundreds of millions of euro to help China develop itself.
We are so kind.
China is super way more powerful than Europe, making way more money than Europe, but France is still sending money to China to help them to develop themselves.
Yeah, we are very nice. We are very nice. I mean, maybe that's. By the way, you have a better mic right now. I don't know what But if you change something,
Yeah, my headphone just broke up, so it
oh,
just got, and I think my mic was on the headphone instead of the microphone.
that's fine. That's fine. It was okay, but now it's excellent. You have the prime quality, audio quality. Yep.
Okay, great.
I know maybe there are some contracts for China and Europe. I don't think we are just doing this because we are nice. I mean, we are nice. We are French, but I don't know. I don't know.
I don't know. To be honest, politics is way too, like, it's another word.
That's not our job. That's not our
Yeah.
job. Our job is to make money, pick stocks. So this is literally not our job.
Yeah.
And yeah, speaking of the market, in your latest videos, you said that this market right now was exceptional, not necessarily the European market, but US market driven by the Magnificent Seven, which is quite obvious. All the big tech are driving these big markets. And in this video, in this latest video, by the way, I will put your channel in the description. You talk about looking for underperforming industries, looking for stocks turning rocks, for stocks that everybody hates. So what do you see of value right now? What are the sectors that you find interesting at the moment?
So, to be fully honest, since 2 months, I would say utilities were like really underperforming, while it's something that you absolutely need. It's not like you can stop having electricity. It's not like you can stop having water. So I would say utilities, but it grew like since few months. Like utilities grew. I'm not saying it get back to the track of S&P 500, but it's way less undervalued than it was a month or 2 years ago. Like for me, utilities is what somewhere where I was investing mostly like 2023. It was, I think, a good year to invest there. Now, I think I did the last stock I bought in US was Google, like in September, I think, because it was around 150, 155, and I find it a good price. But I don't find any good. I mean, there is plenty of good value area, but I don't find one which is deeply undervalued. Like, I mean, at least in my circle of competence. Maybe if I go out of my circle of competence, I'm sure we can find some which are like undervalued. But now with my circle of competence in US, I didn't find something very undervalued when I'm like, damn, like this is super good value for what it is. So that's why since this summer, I'm mostly investing in China and a bit in Europe. I invested in China like for this literally like 3 months of summer. I was investing in China, and now I'm investing a bit in Europe in some European companies that I find very good price. But in US, to be honest, maybe it's really difficult from my circle of competence to find some markets that I find deeply undervalued.
Yeah. And for the utilities, isn't utility the best sector, the best performing sector in 2024, or one of the best?
One of the best, maybe, but I'm not. I mean, it depends how you look at it. It's one of the best now, yes, because it was deeply, deeply undervalued.
Yeah, it crashed last year.
And like you could have some really good stocks which will give you a 6% dividend, which like will really, really good, like having a good business, having literally a monopoly in a city or in a state, so you cannot really touch them, like generating revenue, which was like super stable. And the nice things also with utilities, it's that they are, how do you say, the revenue are kind of inflation based. That means that if you have 7% of inflation, they can just automatically raise the price of 7% and they will not have less clients, because at the end of the day, you still need water. So yeah, so they have like inflation that helps them to grow, plus the population in some areas that are growing as well. So I find it like nice area to invest, especially with a portfolio dividend, a dividend-oriented portfolio, because if you take the list of the king dividends, I think like 20 or 25% of king dividends are utilities company.
these are safe bets that have been there for decades, and they love dividends. This is for safe investors, safe way of investing. So this is very likely that they will continue to increase their dividends in the future. So I mean, that's understandable. What are the things you look for great investment? I mean, because you have two portfolio, one with dividends, one with more tech, let's say this way. For each portfolio, what are the three key metrics you look at? You said though the dividend yield for the dividend part. You want the dividend yield to be 3, 4, 5%. What are the things to monitor? That could be very helpful for the audience, like practical advice, key metrics to monitor.
So basically for the dividend one, I would say that the three main metrics that I'm looking. So first one, dividend. I want something between 3 and 6, 7% dividend. The dividend and all related to dividends. So the payout ratio, I want something with a payout ratio which is fine. Like I don't want something 90 or more than 100% payout ratio because.
Oh, I think we've lost you. I can't hear you anymore. No. Seems like we are going back to the headphones. No, that's it. That's fine. Okay.
Is it good
back.
now? Yeah.
Yep.
Sorry
Perfect.
for this. So yeah, I was saying that.
Yeah. So payout ratio. Yep.
All related to dividends. So payout ratio, also dividend history. I think it's very important to watch how the company have been doing with dividends and with number when you had the recession. For example, something very strong that happened like in 2008, 2009, how the company was doing during this time. So this is important because it is not telling you that they will be able to manage if you have a new recession on it, but like they are more likely to succeed if they show that they already manage with a big problem. They know how to use the revenue or the money that they have. The second metric is debt, because for me, especially nowadays with a big uncertainty on interest rates, debt can be a very big problem. So I'm trying to have company, not saying without debt, because it will be almost stupid to not have debt. Like if you want to be a big business, most of them need to have debt, but to have a company that know how to manage the debt and is not too high. So I'm trying to find in the industry a company that will have lower debt to EBITDA, for example, than the average of the industry or than the main competitor. And the last metric will be the return on invested capital, return on equity.
Okay.
All related to this, because generally a company with a good return on invested capital, they tend to perform well. That kind of shows that they have a good management plus a good, how do we call it? A good moat. Like
a good moat.
They're good on the market.
Okay, so stable dividend, 4% yield, 5% yield, sustainable payout ratio. So let's say half 50%. You don't want something extreme like 90% of the earnings into dividends, and some decent moat with sustainable level of debt. No, you don't want this business to explode and crash to the floor because of debt, because of bankruptcy, because that's a mess. So, and also a long track record. You want a company that has survived 2020, that has survived 2008. So we are talking about 20 years of track record.
Exactly. Okay. And the thing with this is investing in this as a goal is to beat inflation and protect my money from this inflation and receive like this passive income with dividends. It doesn't need as much research as to beat the market. You just need to have good companies. You just need to avoid investing in shitty company. That's the only main thing with this is you just need to avoid investing in bad companies, because like if they continue to grow at 3-4% per year with 5% dividend, you will have your 9-10% per year, like on long run. Like maybe not for 1 year or two, but on long run you will have it. So here I wanted something where I can invest fast, like every month my revenue, to not keep any cash, to have in this, and then I use the money from this portfolio when I find an opportunity that I think can beat the market on long run.
Oh, so your dividend portfolio is used as a hedge instead of having some cash, you put it
Yeah,
in a safe portfolio dividends. Okay. Oh, quite smart. Maybe you
that's
have
the
to
thing.
pay taxes, but I love the spirit. Yeah. Okay. Instead of
Yeah,
having some
I
cash.
have to pay taxes on the dividend, but I don't know. It kind of motivates me to know that every month I'm receiving more dividends. Every year I'm receiving more dividends. It's also nice to just feel that, oh, this company increased the dividends 10% this year. You didn't ask for anything and you receive more money. And also, I had some very good pick in this where I invested in a company with 7% dividend. And now the company skyrocket and now the dividend is 2%. But it's just the stock that did 100, 200% in this time.
Congrats. Congrats.
So yeah, like this is mostly a hedge against inflation, this portfolio.
Yeah. And what about the growth oriented portfolio?
Yeah.
Three key metrics for the stock picking.
So the first key metric for the growth oriented portfolio is not financial metrics. It's I don't know if we can call it psychology metrics or contrarian metrics. Is I'm looking for stocks that nobody talk good about. I'm looking for things that I don't know, everybody, every time that someone is start to talk about it, you feel that they're cheating themselves. You feel that they're not confident about it. You feel that why would you do this? For example, like, I don't know, like, yeah, typically Meta in 2022,
Mm.
like people will be like, why investing in Meta as Zuckerberg became too crazy? Look, he spent 10 billion on metaverse. Like, he's not a child anymore. Like, this is so childish. Like, yeah, when you have kind of a bad narrative around the stock, it's where it start to interest me. Um, for example, one of the best deals I've made was in 2023. At the beginning of the year, you have the Silicon Valley Bank, Credit Suisse who go bankrupt. So all the regional bank, like the stock plunged like 30% in a week.
Yes.
So it's here that I was like, okay, nobody wants those stocks, so I want them. Give me. And it's where I was like, okay, let's buy this. Like this, where I try to get like the first thing, and then it's yeah. How can I say? It's also looking at numbers. I want something with low level of debt compared to competitors, especially now with high interest and all the interest things that we have. I want company with higher than competitors return on capital, return on equity. I want company with a better like like growth for the future. Like I'm not always looking for companies that have grown better in the past, but that are what they are a point that yeah, I can see that they can grow better in the future, or that the growth that can have compared to the valuation that they have today is good in a sense that okay, for example, sometime you may have a stock that will grow only 5% per year, but the valuation you buy it is so low that having 5% is good. Like having 5% will give you a very good return on the stock because the market seems to expect that they will have no growth. So
Yeah.
just like that is different. And also one of the last metric I'm looking, this is and like understanding the business. Like this is not easily quantifiable because it's not like numbers. It's just like kind of understanding what is going on in the business, understanding if uh, the company can do correctly with this, understanding if the competitors are good or no. Like it's more understanding what the company is doing.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The strategy of only looking at hated industries, hated companies, this is like, I mean, the strategy is different from Michael Burry, but in his investing style, he wants to invest in companies when they are on the roadkill. So when everybody is hating the company,
Yeah.
I yeah, go ahead.
To be honest, like I will not invest in a company that is about to go bankrupt because like you had like those things that I'm in my head like it's not a cigar butt strategy like
No.
what was doing Warren Buffett sometimes like which you can have a last sip before the companies die. I'm really when I invest like the main goal is to be like I never sell, I buy, and if I die with this stock I'm fine. Like that will be the dream that I never have to sell, that is just constantly growing calmly and so on. So I'm not trying to find a company that is at the edge of bankruptcy, but I can have for a good deal. I'm just looking for a company where the narrative around is not good, but it's not the business which is not good. It's just the narrative.
Yeah. Temporary problems. You want to buy stuff when they are on the operating table, struggling, a lot of headwinds, but these will be temporary headwinds. Like after 1 year, 2 years, that's fine. That the business is fine. And as you said, the growth rates can accelerate because now they are a better company. Yeah.
Yeah,
You want to buy them when they are in the eye of the storm, as we say.
exactly. And I think people tend to underestimate the ability of a company to, like, with what we saw with Microsoft, Apple, and so on. I feel like in the head of people, company can only do great and always continue great. And there is, I don't know if it's a bias or whatever it is, but in the cycle of life of a company, you cannot just grow all the time. There is a moment where you will have a bit less growth, a bit less good numbers. I'm not saying they will be bad. I'm just saying there will be a bit less. But with what we compare today, you're just like, yeah, it's not good. I prefer to go on Nvidia, which have 50% growth per year. Like, so I think it's here that you can find some very nice deal. Also, what was a source of deals for me was companies that have lawsuits against, because it's very bad advertisement for them. I'm thinking, for example, about 3M stock. 3M, yeah, like you have lawsuit, but
Visa.
I was amazed with this company. I was in a training camp in Philippines, and all the materials they were using to build this camp, because it was still in renovation, it was 3M. I was seeing 3M logo everywhere in Philippines, in the middle of nowhere, in a little island. And the only thing that they could get to build their house and so on was from 3M. So I was like, yeah, okay. And you know what? Like, this stock cannot disappear like this.
They're everywhere. That's such a big company. I mean, 3M, Visa, MasterCard, Google, Facebook, Apple, all the monopolies, all the lawsuits against. I mean, you have some healthcare. You could buy Chipotle during the healthcare in 2017, like Bill Ackman, and do fine. When you are in the eye of the storm, nobody wants to touch you. You people dump the stock, sell the stock. Hedge funds sell the stock because they don't want to be associated with this lawsuit. That's when us retail investor can go and buy the stock for cheap. That's
Exactly.
that's the life. And so yeah, more buy and hold investor, much more of Terry Smith, Chuck Acre. Where did you uh, learn this kind of investing? Because you covered, you learn a lot, you read a lot, so you have seen a lot of investors. And where did you learn the buy and hold investing, and why did you choose this one?
Like, to be honest, it started with Warren Buffett, because I think, like, I don't know, I mean, maybe a bit like everybody in my generation, it was like Warren Buffett was like literally a god of investment. And this guy is being 60 years, he's just telling, like, guys, buy stock, keep it for life, and it will be good. Just buy a good business at a good price, and it will be good. And when I had this, when you look on internet, you always have people trying to find, like, the good bargain of the moment, like the great stocks that will do a revolution in the industry and so on. While, like, you literally have the best investor in the world saying that don't bother with all of this, just buy a good stock, a good business at a good price, and wait. That's all. And then, like, I started a bit with this. And then I when I got more and more into it, I started also reading about Howard Marks. I don't know, like, I'm a very big fan of Howard Marks, like,
Yep.
because I don't know, for me, he's the one that helped me to pass a step, especially about market psychology, because when you read Howard Marks, you will not really have, like, concrete advice of, if this happened, you invest. If this happened, you don't invest. But more an understanding of what's happening all around and how the crowds are working and so on. So this really helped me to understand, okay, if you want to do same than the market, apparently just looking at the numbers will be good. If you invest in a top 10% company with good numbers, even if you buy some of these, some are overvalued, like, you will still do kind of same than S&P 500. But
Yep.
if you want to do better, you need to go somewhere where people cannot go because they are not smart enough, because they don't have time enough, because they don't have the guts enough, because Like investing in something where everybody's saying it's a bad investment and you go, like it's not easy. It's a very big pressure that it's not a big pressure to take on you, but it's like you really need to accept that you may look stupid for 6 months, a year, or 2 years before looking genius, or before just being like good. And you also need to accept that you will fail sometimes, because you cannot have like 100% of your picks good.
Impossible.
So it's I think it's just where you can have an edge, especially as an individual investor, where you can go somewhere and you don't have any people pressuring you to sell. Because hedge fund manager, for example, it was crazy, all the stories about 2000 tech bubble, like the dot-com bubble, where they were forced by their client to acquire shitty stocks because the client will say, I'm leaving this fund if you don't buy those stocks. And like they were like, we need their money. So, okay, they knew it was bad, but like there's so much pressure on them that they had to do it. So yeah, I got big influence from Warren Marks, Warren Buffett, a bit Charlie Munger, a bit Terry Smith. Like, to be honest, I'm just reading, listening to podcasts of heavy investors that have very good like track record on them, and I just listen to everything.
Yeah, the performance. And if you are in the audience and you don't like reading, you have the audiobooks for Howard Marks memos.
Yeah.
You can listen to them. That's quite handy.
Yeah, and like for free, like on Apple Podcast, you just literally have all the memos from Howard Mark, like with his voice, he's doing them, and you have interview. Like it's literally free. You have plenty of podcasts. I interview like billionaires, like super investors, and so on. So it's like today nowadays you really have a lot of free content, which is very good.
You just have to differentiate between noise, bad content, and good content. But I mean, if you only stay with this circle of great investors, great interviews, you will be fine. If you stay within the circle of with Howard Marks and other great investors, you will be fine. In your answer, you said you want to stay in your circle of competence. Quick question for you: what is your edge? What is your circle of competence? What's inside the circle?
That's a tricky question, because it's difficult to quantify what is in my circle of competence. For me, it's easier to say what is not in my circle of competence. For example, I may sound stupid with this, but I deeply don't understand anything about semiconductor business.
That's fine.
Nvidia, AMD, all of this, like, so, okay, yeah, I understand they create component in your computer that makes them go faster, better, and so on. Yeah, this I understand, but I don't understand what is inside. I don't understand why would you go for Nvidia better than AMD? Why they are better than others? Why like Intel is the biggest with Intel and IBM as the two companies that have the most patterns, but they don't have any patent, but they don't have any good result. I mean, IBM is performing well since a year or two, but Intel is just go down while they have the most patent. How come they cannot manage to stay on the flow with Nvidia or AMD? Like, I don't really understand all of this. So
yeah,
I'm not saying I don't try to understand. I'm just saying that I will not spend hundreds of hours to try to understand one stock in this, while I can just find some other by spending well less time. It's more things that I find, okay, here I feel it's logical. I understand what they are doing. For example, yes, 3M business, for me, it was super logical, super easy, even though it's a conglomerate, so they have plenty of business. But like the main activity is to sell those, what I call those little things that everybody have in their lives. They never saw it 3M, but they have it here and they buy it, and you have it everywhere. So this kind of easy to understand. Nvidia, for me, not easy to understand.
Not easy. It's not easy. It's not easy. The good question to ask if something is within your circle of competence is, if the stock crashes 30%, 40%, 50%, do you know the reasons why this business will survive or will rebound? For Nvidia, I have no clue. I mean, what could disrupt Nvidia for the next 3 years, 5 years, 10 years? I don't know.
For me, I'm just like this. I'm to a point where am I like, I don't know, in my head, for example, in Nvidia, is like, why people are so confident that in 2 years Intel will not produce a better card, or AMD will not produce something better? Why people are so confident that Nvidia will still do better in 2 years? And
Yeah.
I don't understand why. Like, is this the thing? I don't arrive to understand why Nvidia is better. I understand that now with what they have, they are better, but I don't understand why with what they could produce, they will be better.
Yeah, there are reasons. There are generation of chips. The same
Yeah,
reason
yeah, yeah.
why Chinese semiconductors companies are a few generations behind. But personally, this is not my stuff. I don't understand, and I don't try to understand this. Way too complex for me. But I guess you have reasons. But
Yeah.
if this is not your edge, your area, if you don't have any PhD in semis or are deeply interested in semis,
Yeah, yeah, yeah.
you have 50,000 stocks. You can invest in Monster Energy if you want. You can
And
invest
it
in
exactly.
Coca-Cola.
And it can evolve in a sense that I don't know, maybe tomorrow I will go to an event and will be someone like super interested into Nvidia and all these ships and so on. He will spend 2 hours explaining me. Light bulb will arrive, suddenly I will understand more the business, and then maybe I will start investing in it. But for now, with what I have, like, no.
That's great.
Really,
You want to talk to passionate people so that it will
yeah.
be very very easy to understand. If you have
And
a
that's the thing. I think it's important to not be closed as an investor. That to first of all to accept that we cannot understand everything, but also to accept that it's not because today is like this that tomorrow will be the same. Like, you never know tomorrow. I don't know, you suddenly can see a YouTube video that will make you understand the business, or you can see an interview, or you can meet someone that will make you understand this thing, and suddenly you will be super passionate about this and learn everything. So it can change. Like, don't blame yourself because you don't understand one thing or something like this, because it can change. And also, like, if you don't like it, you don't like it. Like, there is so many stocks.
being open-minded and curious is the only way to stay relevant after decades,
Yeah.
because the world will change. If you are stubborn and you don't learn continuously, you will fall behind. And as the world is getting faster and faster, I mean, with the internet, with the AI, if you don't learn, you're dead. Basically, you will expire. You will know that's if you're not a learning machine, you will pay a huge price for this. So
Yeah. And also, if you don't know how to use those machines that are learning super fast, like, you can have problems also.
do you know how to code?
Nope.
Oh, me neither. So we are
But
not learning fast enough.
I mean, ChatGPT knows, so
ChatGPT knows. That's great.
yeah,
ChatGPT
yeah.
can, I mean, the max I have done with ChatGPT is just writing some lines of code to embed a video on a website. That's it. That's the minimal. Some people do an app. They create a video game, a quick game, a mobile game, thanks to ChatGPT or another AI stuff. That's impressive what you can do without learning any line of code. This is just impressive what you can do now.
Yeah, yeah, and it's go fast and it's better and better every day. Like, so yeah.
Have you planned to um, do you plan to do an app, a super app, or a game, something with the code, with AI? That could be a cool project.
Yeah, I would like maybe to create my own app website for stock, to analyze stocks, to put your portfolio, track your portfolio, and so on. Um, there is plenty of competition on it, so I think there is a good market on it. And the
Mm.
problem that I have is most of time when I want to invest in a stock, I need to watch like 4, 5, 6 different websites just to have like the numbers, just to have things from the business and so on. So I just want to try to have something in only one. You have everything you need with reliable data, and yeah, that's something I would like to create. But generally, like, the main goal for the future is to have an investment fund, like to continue to build a good track record and investment fund.
Yeah, that's an interesting project. If you can get more time, save some time thanks to AI, just do it. That's
Yeah,
almost.
I use AI a lot in my analysis, like,
Oh
to
yeah,
be honest.
specific websites, or do you build your own GPT to do it?
I should build my own GPT. I think it will be a bit more efficient, but I mostly use it like I will download all the document from a company from their website. I'll put it in ChatGPT and I will ask him question and I will specifically tell him like answer only with those documents. So like this, I will gain time on understanding the business, because there is plenty of stuff. Like, for example, you will read a presentation of a company like 300 pages, where you literally have 10 pages interesting in it, like with information that will interest you. So like this, I know what I want to know, to learn, so I just ask him.
Yeah, that is a very good advice for the audience. Sometimes you have long documents, 600 pages, and you will be tired to read all of this. So put everything on ChatGPT and ask ChatGPT, okay, what are the 10 most important things in this document and 10 potential red flags that could kill the business? You will get a good sense of if the company has a moat or not, what can destroy the business model, what are the key risks. Maybe you will get things that are only in the small footnotes, but these are quite important. I don't know, concentration of clients. If you only have 3 clients, that's a risk. If one of the 3 leaves you for some reason, for a competitor, you lose a big chunk of your revenue. So this kind of stuff. That's a very good advice.
And that's like the example that you just said. Like, if you have just 3 clients, it can be very bad. Like, one of the main mistakes that I did on a stock I invested in. There's a stock with just few clients like this. One couldn't pay anymore.
Oh,
so got destroyed.
Which company?
It was Medical Property Trust.
And they had a few clients. One of them didn't pay them, so
I
revenue
think, like one client. I was like, it's clinics, so it's hospitals and so on. It's a rates on hospitals and clinics, and one client have a big part of their portfolio like is rented by one client. This one client is going bankruptcy, cannot pay the rent, so totally destroyed the business. Totally.
Wow. Too bad. That's unlucky. Well,
no, to be honest, it's not. Yes, it's unlucky on the sense that I could know it if I analyze the client. Like, I didn't do my due diligence correctly. That's why, like, I made a mistake, and thanks to it, now I know. Okay, if you invest in this type of company, you also need to like check how is the financial health of the clients to be sure that they will be paid. Or in this scenario, one client was a big part of the portfolio, so I needed to check. I didn't do it when I invested. I just checked out the financial of one company. I didn't do enough research. So yeah, so it's not unlucky. It's just like I did a bad job on this one. So it's thanks to this, I could like do better for the next ones.
Yeah, that's some deep research. By the way, how much time does it take to find a good investment idea, from idea generation to doing the analysis and then buying the stock or just holding or doing nothing? How much time does it take for you to do the complete analysis?
So I would say the 2 things that take the most time is finding ideas and understanding the business. Numbers is easier. Like, I develop a little, not software, but a Google Sheet where I can just put what I need and so on. And in 15 minutes, I have a good, I created a kind of a formula, and I have a good vision if it's something that will interest me or not. Same for valuation. It's kind of fast now with all what we have.
Yeah.
What is a bit longer is, first of all, generate an idea, because you don't always, for example, for me with my strategy as a contrarian, you don't always have something which is contrarian. You may have some, but in your circle of competence, also in the country where you're okay to invest, you may not always have. For example, now in the US, I'm not saying all of the markets are up, all of the sector are up, but most of them are up. So I don't find anything contrarian in this. But China was very good like a few months ago. That's what put me there. So it takes time to have the market condition that will fit with your strategy. And also it takes time to find, okay, which stock will be nice in this, which is the one that has the biggest opportunity to bounce back and to do it correctly. Then understanding the business, it's difficult to quantify the time on it. Nowadays with ChatGPT is way faster. Like, I probably decreased by 2 or 3 the time that I was spending on it. But you will need also to count the fact that every time I'm going to gym doing sport, I'm listening to financial podcasts. Every time I have free time, I'm listening to financial podcasts, watching financial video. So it's not time which is focused on one stock or one thing, but this time helped me to understand better. And instead of taking 5 hours to understand one thing about the stock, it will take me 10 minutes because I already listened to 10 experts telling you how to behave if you have this and how they behaved and have good results in this scenario. So it's something that just you create years after years after years if it's your passion, let's say, if you love to do this.
Yeah. And you find the patterns for some businesses.
Yeah.
Some businesses look like some businesses that you researched on 3 years ago. So you recognize the patterns for some businesses and you shorten the duration of the analysis very fast. It's all about qualitative data. You say, oh, this business model looks like a business model that analyzed last year. So that's faster and faster. Yeah.
The main difficulty is finding ideas.
What do you find some good ideas with screeners? Do you have
screeners? I follow also the Dataroma, like to see a bit what are doing the super investors, some newsletter, some financial newsletter. I'm following also like some some news, for example, on Yahoo Finance and so on. You have main news and trying to see where they talk bad about. Where they have a title saying like, oh, it's the end in this in this area, in these things. This can help also to find some area of the market where you may have some interesting thing. For example, about China, the thing that convinced me to invest in China was I was typing on Google debt to GDP United States, debt to GDP France. So United States, you have 122% approximately. It may change. France is around 110, 112%. It's like, okay. Then I did it for China. And for China, they show me 300%. I was like, what? How come? Like China the country is known to don't have a lot of debt and to mostly give money to other countries and more receiving for debt. So how come they have 300%? So I click on the article to read a bit more because, it's mostly the titles and so on.
Yeah.
And you just realize that the things that they put on top in Google is to calculate GDP, debt to GDP for US and France. They use public debt to GDP. With China, they use public debt plus private debt to GDP, which is totally nonsense. But in reality, the public debt of China will be like 80%, something like this, which is good. So when I saw this, I was like, okay, like all the media, everything is talking, we'll say bad about China. They say like it's senseless. Also, plenty of people about stock market and so on, like talk bad about it. Then you have few investors that I really like. I see them investing. For example, you have David Tepper. 12% of his portfolio was Alibaba, and I think 20% of his portfolio is China, or 15. You have Howard Marks, which have like built something like 6% of his portfolio on JD.com, which is China. You have Michael Burry, 15% or 20% of his portfolio China as well. So I was like, they may have something. So I went more on the market, and I just arrived to a point where I estimate that the downside is way too low compared to the upside that you can have. Like, I'm not saying the stock cannot go more down, but literally if the stock go more down, you have a market cap equivalent of the cash that the company will have. So you're like what is really the risk? Like you just take the cash back. So I was like, yeah, the upside is way better than the downside.
Yeah. Downside is quite limited with the good balance sheet. And most of these companies in China start to do some dividends, buybacks, giving money to shareholders. So us Western guys, we often asked, will we get the money again? Will we see the money again? But seems like it is. Seems like we have dividends and buybacks. So they are more shareholder friendly now, Chinese equity. So yeah, your strategy, looking at the doom and gloom articles, looking at the red articles with red arrows, that's a very good way to find stuff that is hated. And if the data is false, that's even better because you are focused on
false or manipulated. Like, by the way, now you have I didn't think about it, but you have an area which is kind of not in a bad shape, but have some good opportunities, healthcare.
Yeah.
Like you have a lot of pharmaceuticals and biotech and so on that the stock is really going down. So I'm not saying you have big opportunity in this, but it's somewhere when I'm doing more research about, because you may have some good opportunities.
Yeah. Yeah. I mean, I'm not a fan of the healthcare industry. You have Humana, CVS. I understand why these stocks are going down, and I mean, well, these stocks are out of my circle of competence, so I won't touch them anyway. But regarding capital allocation, I don't think that these are the best companies to invest in.
It's difficult, yeah. Like having a pipeline for a new medicine, which is 13 years minimum, with a 10% approval. Yeah, like, but some companies and saying this, they've shown since 200 years that they know how to manage this and they are doing great, that they are a good thing on the pipeline. So yeah, we cannot know if the drug will be approved, but we can see very big tendency of the company being able to do good even in the
Yep.
situation. So it's where you can have some value. Yeah.
Yeah, absolutely. So that's some good advice. Look for doom and gloom articles.
Yeah.
Look for screeners. Look for blogs. It can be even Twitter or YouTube. Ideas can come from anywhere. Do you have other advice for somebody? I mean, most of the viewers on this YouTube channel are people that love stock picking, serious investors, long-term investors. They want to build their own portfolio. What are other advice that you could give them that they want to build a strong portfolio with strong companies?
Like I think, like, first of all, it's to be clear on what you want, because you really don't manage a portfolio the same way if you just want to hedge the inflation than wanting to hedge, than wanting to beat the market. For example, for me, it will take me 2 hours to analyze the stocks that will be in my portfolio to hedge inflation. But to hedge, to be like better than the market, here it will take 50 hours, like maybe more. So it's just, first of all, you need to be clear of what you want, because you cannot say like, I want to beat the market, and then say, oh, I don't have time, I'm working already 90 hours a week with my job. Like, I'm not sure it can be like compatible, it can go together. I don't. So maybe yes, you can follow some people on internet that will share their portfolio and just follow what they are doing, but you just dependent on them. Like, you're not like, it's not you who takes the decision. I mean, you take the decision on investing, but the ideas and so on come from somebody else. So this is the first thing to understand: is what is your goal? What do you want from this portfolio? What is the goal of it? And second, I will just say, like, try to develop something which is not which we need more than just the numbers. Try to develop attitude, state of mind that is just not just looking at the numbers, but trying to understand something else. To do a bit of a step ahead, because today the market is so, like, you have everybody have access to information. Everything is free, public, and you have dozens of great brain analyzing stocks for free, and you can have all of this. So just remember one thing: if you have access to it, you have millions of people having access to it. So you need to find a way to be smarter than those people. And I think at some point, like, studying the psychology of crowds can really be an edge, because yeah, I'm a big partisan of the market is most of time efficient, but you have this 5% of time where it's not. And it's in this 5% that you have your edge, that you can do something, that you can really go to take some performance. And also, don't try to do a 6 months, I don't know we call it, but like, to buy something and having the goal to do a 10x in 6 months and then just leave and make things like this. Like, I don't want to destroy your dreams, but the probability of success in this are very, very low.
Or you can destroy their dreams. If you think you will do a 100x in 1 week and then you can retire in the Bahamas, impossible.
Yeah.
Or if you do, call me. You have my mail in the description, so invite me to the Bahamas. But I don't
Yeah.
know anybody who has succeeded in this strategy.
And also take care of the scam, because I think I had so many clients losing money with stupid scams. Like, if you feel something is a scam, just remember one thing: Jim Simons which was a total anomaly in the market, made 60% per year for the last, 20, 30 years, 40 years, 60% per year. And he was considered as an alien from all the investors. Like nobody could understand deeply what he's doing. They knew he was doing something with mathematical, algorithmic, something super fast and so on. Yeah, they knew this, but nobody was ever able to replicate. So if you have somebody contacting you, telling you, I can do 1%, 100% per month for you or per week, it's a scam. You have somebody with an audited track record and nobody understand how he did 60% per year. So like, no worries. If someone tell you I can do 100% per month,
Run.
like run, just run. Just realize that, yeah, like even if you manage to do 20% per year, you will be in the top 1% of investor in the whole world. So, yeah.
Your pump and dump scheme, yeah, Ponzi scheme, 100%. I see this kind of stuff. They say that there are signals on Telegram,
Yeah.
and you just have to buy this, and this crypto will go to the moon. And wow, I see so many people complaining about this, being scammed, losing thousands, the tens of thousands of dollars on these stupid scams, and people will fall for it because, I mean, at the end of the day, humans drive the stock market. We are all humans. You have some algorithms, but mainly humans, and humans create the algorithm. So easy, as you said rightly, psychology is so important. If you know where you're going, if you have a clear objective in mind, a clear path, okay, I want to do 5% per year, 10% per year, beat inflation. You have your goal and you stick to your goal. You don't shoot for the stars. That's how you get burned. That's how you do many, many mistakes. So that's a very, very good point.
Yeah. And also just accept the fact that the numbers don't say all. Like you can have some companies that will do extremely great performance, but with not, and company which will do very bad in terms of stock price evolution. Some will have bad numbers when you look at them, and some will have good. You will have bad numbers going super up, skyrocket, and good numbers not skyrocketing. So just trust the process is not always like the best companies that can go up. So you need to accept the fact that you will never have a green flag on everything when you will invest in the company. And the most important is not to have green flag everywhere, is that the flags that are yellow or red, they are not eliminative for you. Because, for example, you can have some companies that they have a problem, let's say, with debt. And you're like, yes, they have a pretty high debt, especially compared to the competitors and so on. But it turned out that this company, maybe they have this high debt, but the things that they bought with this debt is worth 100 times more than what all the competitors could have. So yes, on the numbers, the debt is bad, but in the fact, in what they did with this debt, is something that can be 100 bagger for them in the next years, especially if the board have an historic of showing that they know how to manage money and they did great.
Yes.
So yes, numbers are important, but they are not everything. You need really to understand this, especially if you want to have higher returns.
Yeah. Qualitative side on the long term is the most important stuff. The vision for the management, the culture of the company, is what matters in the very long term. We're not talking about 2 years, we're talking about 10 years, 20 years. This is what matters. And all these enduring companies that have become better and better and better, decades after decades, have this strong culture for the long term, good incentives, etc. You have common traits for all these great companies. Yeah, very, very good advice. Very good advice. Okay, last question for you.
Yeah.
Where should people go to learn more about you? I will put your YouTube channel in the description. If people have a question for you, where can they contact you?
Yes, they can contact me by email. So they can just go on my YouTube channel, do more, and they will have my email address. So they can just write me an email if they have some questions. They can contact me on Instagram as well, which is my Instagram tag is my name is Fournier. Yeah, for the channel, like if you're French speaking, you're welcome on my channel. If you're English speaking, you're also welcome. It's just we're not speaking English in my channel yet, maybe in the future. But if you have some direct question, yeah, I think Instagram, LinkedIn, you can find me with my name and surname. My email is on YouTube. You can find me easily, I guess.
Yeah, you're present. You've been making videos for years, so he has the track record. Don't worry, don't worry. Okay, well, thank you for your time. Thank you for coming. It was very helpful to the audience. I guess you can, if you like
Let's
the
hope.
videos, you can leave a like, comment if you have any question, and we will be very happy to chat with you. So thank you, Guillaume, again for coming.
Thank you, Christophe, for the invitation.
Okay, bye bye. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.